So we are looking forward to having you all in our boardroom again one day, hopefully in the near future. But actually the one advantage of doing these seminars via Zoom is that we're actually getting record attendees at these seminars. I'm not sure what the actual numbers are, but we're around up to the nearest 500,000. I think we must have 500,000 people or so coming today. So thank you for your support and continuing to come to these seminars. We'll start about 9 o'clock. I will just give people a bit more time to come in. But in the meantime, just before we do start, there's one thing I like to do on the last day of March. It's give myself a large pat in the back, and that goes for everyone here at HLB. So if you see many HLB people today and they're walking around giving the large pats in the back, the reason is that we've been very successful again in the Client Choice Awards, which were announced, I think, last week. We won the Best Professional Services Firm, revenue between 50 mil and 200 mil. The Best Accounting and Consulting Services Firm, with revenue between 50 mil and 200 mil. And one of the partners in Perth, Litsa, Chris Todolu, won the Best Accountant. So thank you to everyone who voted for us. I think we've won the Best Accounting Firm award about 500,000 years in a row, rounded up to the nearest 500,000. Of course, those awards are not voted for by us, they're voted for by our clients. So for everyone here today that voted, thank you very, very much. And you should give yourself a pat on the back also. We appreciate your support during these times. Welcome, everyone. Thank you for joining our webinar. My name is Aidan Smith. I'm the head of not-for-profits here at HLB Man Judd, and I'm your host this morning. So today we're presenting a financial reporting update with a top expert in the field, and that's Carmen Ridley. But before I introduce Carmen, a bit of housekeeping before we get started. We'll take questions at the end of the presentation. So you'll see in Zoom, you've got the Q&A box at the bottom of your Zoom control panel. Don't put them in the chat box. You've got a chat box and a Q&A box. The chat box, good chance we'll miss them. So put any questions you've got in the Q&A box and we'll answer them at the end. Now, I'd like to introduce to you Carmen Ridley. So Carmen is a member of the GAP Consulting Network and Principal and Director of Australian Financial Reporting Solutions. Carmen provides the role of a technical auditing and accounting division for a range of clients in the private and public sector, and she ensures she keeps up to date and aware of current accounting and auditing issues, which has established Carmen as a recognised expert in financial reporting arena. Carmen was a board member of the Australian Accounting Standards Board from 2012 to 2020 when her term expired, and she's currently a member of here's a few acronyms here, the IASB IFRS for SME Implementation Group. IASB is International Accounting Standards Board, IFRS is International Accounting Standards, and SME, as you know, no small, medium enterprises. So that's Implementation Group for Accounting Standards internationally, for SME Group. So Carmen's very much an expert here. Carmen's also a key speaker for CPA Australia, and she's written and presented a number of their financial reporting professional development courses, and done that for a number of accounting firms and corporate. In addition to that, Carmen's recently completed her company director's course with the AICD, Australian Institute of Company Directors. So after hearing that, you must think Carmen's some kind of accounting superstar, and you must feel honoured the opportunity to hear from her today. And some of you might think that she knows more than me. Well, hold your horses there, but indeed, Carmen is an accounting standards superstar. And actually, would you like the chance to speak with Carmen? Because that's something we're offering everyone an opportunity to do today. And how? So hang around, you'll find out towards the end of today's presentation how you can get this chance, and also to provide some feedback on recent accounting standard changes. Anyway, enough from me. It's 9:04. I'll now pass you over to Carmen for the presentation. Thanks, Carmen.
Fantastic. Thank you, Aidan. That was one of the loveliest introductions I've ever had. So thank you for that. And welcome everybody to this session. We have got an hour and a half or so to have a chat today. And I guess when we were looking at what we talk about, I don't have the major standards that I've had over the last few years to talk about. Those of you who've attended these sessions previously, we've spent a huge amount of time talking about revenue and leases. What we're going to talk about today is a bit of a mismatch of everything. So you can see on my slide here, I've got lots and lots of different topics that I'm going to talk through and going to cover off for you. So we'll get into it. As Aidan mentioned, please ask questions. We will leave time at the end for questions. But if I do happen to see one pop up, or Aidan has full permission to interrupt me during the session, if a relevant question comes up, and we can talk about it at the time. So let's start with new standards for 30 June 21. I said that in the previous few years, we have spent lots of time talking about the new standards, the major ones, and I may have said to you that we're about to enter a period of rest. Might not look like it because I've just put up a slide that's got 8 new accounting standards for 30 June. I am going to talk through them, but I'm going to talk through them in the context of the not-for-profits who are listening and how I really don't believe that these standards will have huge impacts for you. So whilst it does look like a fairly long list, hopefully you will be convinced we are still in a period of rest. The first one is to do with the definition of a business. So this is important because if we've acquired some stuff, we need to know whether we've acquired a group of assets, in which case we can recognise them in accordance with the Property, Plant and Equipment Standard, or whether what we've acquired is a business. And if we've acquired a business, we have to fair value the assets. We have to look at whether there's any identifiable intangibles that weren't recognised by the seller. We then compare that with the consideration and we potentially end up with goodwill or a gain on bargain purchase. They're quite different accounting depending on what we've got. I think over the next few years, we might see a number of entities, both in the for-profit and also in the not-for-profit space, who just say life's just too hard at the moment. Our expenses are too much. We've got too much uncertainty around whether we can operate, whether we're in lockdown, whether we're not in lockdown, and just hold their hands up. So I think there'll be a fair amount of acquisitions happening. So what I do want you to do is just bear in mind, if you get that opportunity, just think about the fact that this definition has changed. It talks about whether there are outputs of the entity that you are acquiring, and there's different rules around whether there are outputs or whether there aren't outputs. Have you acquired a workforce? Have you not acquired a workforce? So although that you would have studied business combination accounting and worked out what the definition of a business was, if you do find yourself in a position where you are acquiring a group of things and you're not sure whether it's an asset or whether it's a business, I would encourage you quite strongly to have a look at that. That will be incorporated into AASB 3, but that's just the name of the standard number as it is. It hasn't yet been compiled. The next one is to do with materiality. Now, anyone who's attended any of my sessions over the last few years would know that I get on my soapbox a little bit about decluttering and trying to get the rubbish out of financial statements. The International Board have been doing that as well for the last few years. And what they've done this time is they've slightly altered the definition of material. They obviously can't say, get the rubbish out of financial statements in an accounting standard. So what they've done is they've said, don't obscure material information with immaterial information. So within that definition, they've introduced that word obscuring. So what they're telling us is more isn't always better. Just because we've got a really long set of financial statements with lots of information in there, doesn't mean that's more useful to the user. So just think about that when you're going through your financials. I know for many of you, it is just a compliance document that has to be done. Many of you who are listening would have June year ends. We're at the 31st of March today. I would encourage you, if you have chance before you start the chaos of your 21 financials, just read last year's financials. Start at the start, finish at the end, and just read it with a red pen in your hand and cross out everything that's not relevant, that you think, well, that really doesn't add anything. Why is that in there? Just because it was in there last year doesn't mean it should be in there. And really try and go through and cull some of that information. It will take you some time, but it will also save you time, because if you can get information out, that means you're not preparing the information for the current year. The next standard is purely to do with the public sector. Now, this session is tailored for the private sector, not for profit. So therefore, I'm just going to give you a very quick overview of this one, but shouldn't have relevance. This is for a situation where the public sector has got the private sector to do a public service for them. Could be a toll road, it could be a hospital, it could be a jail, whatever it's going to be. This standard just tells the public sector how to account for that. If you're the private sector doing the public service for them, so for example, some of the social housing, there's an interpretation that deals with that, an international interpretation, but there was nothing helping the public sector. So it's just closing that loop. So both parties to the agreement have got a way of accounting. The next one is again a very public sector orientated standard. So internationally, the ABS, the Bureau of Statistics, is required to report on certain metrics within the country. Financially, it's called GFS, Government Finance Statistics. And there's a difference between the GFS and what we're required in the accounting standards. So where there's a difference, the whole of government at state, territory and federal level have to reconcile those differences. All this standard does is give them some relief from a couple of those reconciliations. Wouldn't impact anyone in the room, the virtual room. Next one is a conceptual framework. So I'm not going to ask anybody to raise their hand on Zoom if you have recently read the conceptual framework, because it would probably be a fairly embarrassing silence. Remember from when you did your studying, or those of you who currently are studying, the conceptual framework is a really important document. It's effectively our umbrella. It's the document that as standard setters, they use to make sure there is some cohesion between the standards. It's a document that has the definition of assets, liabilities, income, expenses. It tells us that our financial information should be faithfully represented. It should be reliable, it should be relevant, it should be timely. It's also the document that we go to if we undertake a particular transaction and there's no explicit accounting standard. So the framework is what helps us develop an accounting standard that we can use. Now, given how important I've just said this document is, why am I really saying that these don't have any impact for you? Because at the moment, we are running 2 conceptual frameworks within Australia. I'll talk a little bit later on about the Australian reporting framework, and this new conceptual framework was really the catalyst that allowed us to remove the ability of certain for-profit entities to do special purpose. If we'd introduced this immediately for everybody, it would have meant that there was no special purpose allowed for anybody who was complying with standards. We didn't want to do that. We thought that was a little bit harsh. So consequently, we're running the 2 frameworks. The not-for-profits are under the old framework, which is called the Framework for Preparation and Presentation of Financial Statements. So if you need to use the framework, that's the document you use. It's not necessarily very clear on the AASB website which one is for who, but you're looking at the one called Preparation and Presentation of Financial Statements, not the conceptual framework. Eventually, we probably will bring everybody up onto the one framework, because it's not really long-term sustainable to have 2 frameworks and 1 set of accounting standards. That's why that one doesn't have any impact for you. The next one is not an area I know a huge amount about. Internationally, there was this benchmark called LIBOR, and LIBOR has now been removed. For some, mainly financial institutions, they had hedging, so they had derivatives that were linked to LIBOR. So if you remove the benchmark, your hedge effectiveness is going to go a bit skew-if. This standard just helps in any situation where you had a hedge that was linked to LIBOR. I would be stunned if that had any impact on anybody at all listening. The next one is our favorite disclosure, our standards issued, not yet effective disclosure. So as you'd be aware, every year you need to look at the standards that have been issued by the Australian Accounting Standards Board that are not yet effective. Where they are relevant to you, you need to describe what the impact would have been. What this standard says is if you give an IFRS compliance statement, so not just an AASB one, but an IFRS compliance statement, you also have to look at the standards that have been issued by the international board that may not yet have been issued in Australia. There's generally about a 3-month lag between the issue internationally and the issue in Australia, just because our standards have force of law. There's a bit of red tape that has to be jumped through. You guys as not-for-profits cannot give an IFRS compliance statement because there are not-for-profit paragraphs within the standard that do not exist in the international standards. Consequently, standard not relevant for you. However, it does give me an opportunity to talk about that standards issued not yet effective note. So let's say instead of this standard being called 30 June 21, I'd called it 30 June 22. And I was telling you about all the standards that have been issued that were not yet effective. Most of these, I have said, are not relevant to you. So if we think about that disclosure that you have to include, and you have to include it, it is a mandatory disclosure required by AASB 108, which is a mandatory standard required by the ACNC. You don't put this list in because most of them aren't valid for you. What I often see is I see this big long list and I see a generic boilerplate description of what the change in the standard is, which has been copied from something, which is fine, and then a note at the end that says this is not relevant to the entity. If we think about that change to the definition of material and don't obscure material information with immaterial information, putting stuff in and telling me it's not relevant is immaterial information that's just cluttering the financial statements. So just think about this particular note that you put in there, making sure that you are complying. The last one I am going to go through in a little bit more detail. So this is a standard that was available for early adoption last year, and many entities, I think, who it was valid for did use it, but I just want to remind you. So again, I'm just going to paraphrase. What the standard setters said is that if you have a modification to your lease modifications is actually really hard. And we're going to go through a few examples of that a little bit later on. But lease modifications is really hard. Given how many modifications that we are seeing because of COVID, we want to make life a little bit easier for the lessees because they're obviously in some financial difficulty, hence the reason that they're receiving rent waivers or rent deferrals. So if we can make the accounting simpler, that will help. And that's what this was to do. It was purely to make life easier for lessees where certain conditions were met. So you received a waiver or a deferral, which meant that you were either still paying the same rent, but you're paying it a little bit later, or you're paying less rent. That's point number A. The second one is that reduction in lease payments affected payments only due before 30 June 21. There is a proposal out there to extend that to 30 June 22. The International Board have now approved that. It's not yet been issued within Australia, but it will be. So if we assume that that's going out to 30 June 22 and nothing else in the lease changed, you didn't change the scope, you didn't change the lease term, you didn't change anything else. It was purely just to do with the payments that you've made. Then what you do is you account for that concession as a variable lease payment. So if we look at what that actually means. Now, what I did is I stole this from the staff paper that went to the International Board when they first proposed this standard, because I think it's a really easy way of illustrating it. It might not look easy when I've just put this slide up, but it's a really easy way to illustrate what's going on. So the fact pattern is at the top. Essentially, you're paying $100 a month and there's interest charge of $20 a month. So my first column is nothing has changed. You're just carrying on as normal. So we decrease the lease liability by $100 a month. We have an interest charge of $20 a month, and we just happily keep going. The second column, the landlord says to you, look, I know that life's pretty tough at the moment, so we're going to let you off. You don't have to pay us for the next 3 months. There's no catch up, there's no trick, just we'll let you off for 3 months. So instead of going through and recalculating all of the lease liability, the right of use asset, etc., what this exception allows you to do is to say you've just got a benefit of $300. Just take it to the P&L. So you can see in that first entry, we reduce the lease liability of 100 because we have been let off 100 times the 3, and we credit the P&L with effectively a negative variable payment, which is an income. We still keep going with the interest. In the following 3 months, we still go back to normal. Just is there to make life a bit easier. The third column is we say you don't have to pay us for the next 3 months, but we're not letting you off. All we're doing is giving you an extra 3 months to get yourself back on track, but we want that payment in June to August. So nothing happens for the first entry because we haven't been let off and we haven't paid anything. We still continue with that interest charge. And then in the second 3 months, we pay the $200 a month, we reduce our lease liability by that. The fourth one is a bit of a combination. So we say, okay, we're going to say you don't have to pay us anything for the next 3 months, but we want increased payments after that. However, we don't want all of them. We're going to let you off for $40 a month. So we only want you to pay us $160 going forward. So we've got a benefit. We've got a negative variable payment of $40 a month. We recognize that as soon as we get it, and then we carry on as normal. So hopefully this just illustrates, as I've worked through, the different elements that might happen that are under the scope of this particular standard, and you can see how you would account for them. If you choose to do the lease modification properly, there is nothing stopping you do that. You can go for your life, you can absolutely go through and calculate it. It's a huge amount of work though. This makes life much easier for you. So it becomes effective this year, was available for early adoption previously, but it's important to remember that that date will be extended to 30 June 22. So if you previously it was 30 June 21, and you would have been knocked out if there is any concessions after that. But depending on where you are listening from, the likelihood of concessions after 30 June 21 may change quite significantly. All right, the next thing I want to talk about is just to raise your awareness of some resources that are out there to help you. So the AASB staff over the last probably 12 to 18 months have written a number of frequently asked questions. They are available on the Hot Topics section of the AASB website. They're not necessarily overly well advertised, so you might not be aware of them. They aren't authoritative, and in fact, many of them don't actually go to the board. And what the staff very clearly try and do is not interpret a standard, but to really give you some more factors and things to think about. So they can be a really useful resource. Many of these were written to deal with the issues of COVID. Standard wasn't changed. The only change was that one I've just talked about. Standards weren't changed, but we were obviously operating in an environment that the staff believed we needed a bit more help. So consequently, we've had a bit of a rush of these staff FAQs over the last few months. And I just wanted to alert you to the fact they existed. I'm just going to give you a very brief overview of what each of them contains. So the first one is our events after the reporting period. It was written in the context of COVID. The AASB is based in Melbourne. On the 7th of July last year, we went into a full lockdown. Consequently, the AASB knew that every entity that was based in Victoria was going to have some issues about how do we decide, is this an adjusting event or a non-adjusting event? Because it was the first time we'd had one so close to the reporting period. So whilst this document is written in the context of COVID, effectively what it does is provide a really great overview of the events after the reporting period standard. And this particular diagram here I've stolen just straight from their document. It's probably one of the best decision trees that I've seen around deciding whether something is adjusting or non-adjusting, and deciding of the factors to think about. So if you have something that happens, again, depending on your year end, depending on where you are, we may find that something happens after that year end period before we sign that we need to go, what do we do? Is it adjusting? Is it non-adjusting? How do we deal with this? It's a good document. It's written fairly plain Englishly. It's not hugely long. It's not hugely technical. So I would recommend having a look in that one. The next one is to do with remuneration underpayments. Now, hopefully this is not relevant to anybody who is listening on here, but obviously we have had a huge number of these underpayments over the last 12 to 18 months. So again, whilst this is written in the context of what do you do if you've got a remuneration underpayment, what it essentially does is give you a really good overview of how do you deal with the prior period error. When do you adjust it? When do you not adjust it? Where do you adjust it? What do you disclose if you've got an error? So it's equally applicable if we have any errors. Nobody wants errors, but they happen much more commonly than we actually think. So again, another useful guide for you if you do have the need to look at this one. Next one is impairment. Again, written in the context of COVID, but it's just a summary of the impairment standard. So it's equally relevant at any time that you look at it. There's some really good flowcharts within this particular document. I haven't recreated them, but recommend, I've got providing to clients, that should be directors on there, apologies for that. Providing to your directors, if you are discussing impairment issues, it is something that is always on ASIC's list. And whilst you guys may not be governed by ASIC, we absolutely should be looking at what is on ASIC's list to guide the conversations we should be having to our directors. Because you guys could have impairment issues too. So this is, if your directors go, we don't know what impairment is, you know, this is a really useful document to have a look at. You can work through it. You can work through the flowcharts with them and say, this is why we don't have an impairment, because this is the path that we've followed through. The next one I then lumped together, I was only going to talk about the new ones, and then I lumped together some of these. So there is an FAQ that is called Revenue for Not-for-Profits. It contains a number of different questions, and some of them aren't new. Some of them have been around pretty much since the date the standard was issued. So I'm only going to talk through the bottom two. The first one deals with scope and effective dates, and that was around where there was confusion because the not-for-profit revenue standard kicked in after the for-profit one. So those ones probably aren't relevant to you anymore because you've already looked at those. Accounting for research grants was issued before the 30 June 2020, not 2019 reporting periods, because there was huge confusion about how research grants should be accounted for. It resulted in a few examples in the standard being changed. It resulted in this FAQ. As I say, it's not new. Hopefully, if you got any research grants, you were aware of these FAQs at the time. The next one is around performance obligations in not-for-profit schools. Again, this one's not new. This one's been around for at least 18 months, I think. It deals with what do you do if you've got waitlist fees, what do you do if you've got enrollment fees, and tries to define what the example means by those terms, because I know different schools call them different things. So they're the ones that have been around a while. The two newer ones, the ones I'm going to talk about, is concessionary loans and grants received in arrears. The first one are concessionary loans. So this is included, you won't find a concessionary loans FAQ. They are included within that not-for-profit revenue one. And the question that kept being asked is, if we receive particularly an interest-free loan, generally it's from the government, but if we receive an interest-free loan, is it in AASB 9, the financial instrument standard, or is it in AASB 1058 because we've received something at significantly below market value? The answer is it's in both. So it's in both AASB 9 because it's a financial instrument and AASB 1058 because you've received something significantly below fair value. So then the question was, well, which do we apply first? We've got two standards. Which one do we do? And what this decision tree is trying to do is to tell you it really doesn't matter. Whichever one you apply first, you then follow with the other one and you will get the same answer regardless of which way around you do it. So it just gives you some guidance to, again, work through. And the great thing about the flowcharts is you can grab your highlighter and you can follow it through and go, this is why we've done what we've done, because this is the path we've taken in our flowchart. So hopefully helps with some of the accounting. So if you do receive a long-term loan below market value, and that includes zero. The next one that we've got, I haven't given you an answer on this one. And the reason I haven't given you an answer is because I'm not 100% certain on the answer that the staff have come up with. So hence I want to talk through the issue rather than just give you what the FAQ says. All right, we have a situation where you guys have received funding in relation to community engagement. I have deliberately kept that vague because I want the conclusion that the agreement is not sufficiently specific, but it is enforceable. Hence, you are not able to get within AASB 15. I'm forcing you within AASB 1058. I tell you that we receive $100 per community engagement session. So I haven't defined what that is. You decide what a community engagement session is. So hence it's not sufficiently specific. There's $100,000 of this grant available. We're assuming that's material. And effectively you submit a claim every 6 months to tell the government how much of these or how many of these sessions have you run and to claim the amount that you're paying. Now, AASB 1058, we very much focused on excuse me, I am fighting something that is not COVID, so bear with. So when we wrote 1058, we were very much around grants received in advance, because that's what the questions were that we were getting. We've received the cash up front. What do we do? In this one, it's the opposite. Excuse me. So we've got 500 sessions that have been held between January and June. What I want you guys to think about, and I don't think you can type it, you may be able to put it in the chat box, it may come through. If not, I might have to pick on Aidan. So I want you to think about what entries would we be recording in the period to 30 June in this scenario. So you have held 500 sessions, you can't submit the claim until July. At 30 June, what am I recognizing? Give you a few seconds to either type it in, if you can, do have the chat box, and if not, I'm giving Aidan a bit of heads up that I'm going to bring him in.
maybe we should give everyone 30 minutes to answer this one.
30 minutes for that
Yeah,
one. Yeah, so you can run away and get an answer. Fantastic. So somebody's typed in, and we've got a accrued income and revenue. Another one's got accrued income and revenue. Yep. Aidan, do you have any thoughts you would like to share on this one? And I haven't given Aidan any notice. I've literally just thrown him under the bus.
All right. I'm going to qualify this initially with here's a suggestion. I'm saying it's my suggestion. I would agree with the comment, not with all the comments, but the ones that come out so far, that you bring it in as the accrued income because the agreement is enforceable. Therefore, you're entitled to that. And I know the 1058 question is like you record it on receipt. Normally, when it's not specific and enforceable, you record it on receipt. This one hasn't been received, but I'm going to apply, I don't know accounting standards, but always do this, the common sense point of view to say that this one will be received and therefore it's okay to record a receivable.
Okay, fantastic. Thank you, Aidan. So I'm going to pick up on a couple of points that you made. So you did say 1058 requires revenue recognition on receipt. But what is it on receipt of? It actually says when you are entitled to an asset. So what we've all focused on is the cash, but do we have another asset? The two answers that came through the chat box, being debit accrued income, is effectively where I want to be. I want to debit accrued income. I actually really wanted to debit contract assets. The staff FAQ doesn't say that. The staff FAQ says that you should debit a receivable because they weren't comfortable using a contract asset because the contract asset is in 15 and I've deliberately scoped this out of 15. I was happy just dipping back into 15 to pull certain things out that I wanted to, but they weren't quite so comfortable. They didn't want to call it accrued income because that's not defined anywhere in the standard and they felt uncomfortable calling it this term that we're all familiar with, but it's not in there. And they then looked in, buried at the back of AASB 9 is a comment that says if a contract is enforceable and you have a contractual right to receive cash, you can have a receivable. So that's where they've pulled it from. I'm still not 100% comfortable in a receivable. I would still rather have our accrued income or a contract asset, but that's what the staff FAQ says. And I think the most important thing is that we would recognize the revenue because you have done the work, you are entitled to it. And therefore, that's to me the important thing. Whether you put something in a receivable or an other asset or a contract asset, it's probably not a big deal because it's all going to sit within your current assets and it's going to be valued appropriately. So this is an area that we probably didn't focus on enough when we wrote the standard because all of the attention, all of the questions we were getting was grants received in advance. What we are hearing is the government has switched their model in some situations and there are more of these grants received in arrears that are coming through. So just be aware if you are in this situation, there is that staff FAQ to help you. As I say, I think the biggest thing is that you can recognise that revenue.
Carmen, just to say this session's been recorded, so just for the record, I think I got that one right. So
yeah, all right, you got it right because you copied what people had put in the chat.
You know, it doesn't matter. So got it right. That's the best auditor to copy someone else's answer.
Absolutely. All right, so it leads us beautifully into implementation of 1058 and AASB 15. And we will come back to this towards the end of the session. When Aidan said you had the opportunity to talk to me, I am looking for some help and your views on how you found this implementation. And I'll explain more as we go later on towards the session. So I've been over the last few weeks doing some travel interstate. I have managed to get into different states before they've been locked down, which is where I picked up this bug from New South Wales. And I've been hearing a few sessions and sitting in a few sessions with various other stakeholders where we've been trying to work out with other entities, how did they find the implementation? What did auditors see around the implementation of this particular standard? Can I give you any hints about going forward? Because these standards are here to stay. So whereas last year there was a really mad panic on let's get these numbers right. It's the first year, we need an opening balance sheet, we need to get the numbers. We now need to kind of go, things have settled a bit, but what are we doing going forward to make sure that we've really got the implementation working, we've got a process working. Life is not as stressful in relation to these standards. By far the consistent theme that I hear every time I talk to anybody in the not-for-profit space, whether that's not-for-profit private sector or not-for-profit public sector, is the earlier that entities get onto this, the easier it is. As soon as you try and wait till the very year end or in that period after the year end when you're putting together the financials, it's just chaos. There's so much other stuff going on. So that's my biggest hint for 2021 is make sure that you have started early. We have got new agreements, new contracts, new revenue streams that would have appeared during this year. What have we done with them? Have we, as soon as we were aware that we were getting these agreements, these grants, whatever it was, did we then go through a process to say, right, let's get our revenue recognition methodology bedded down for these? If we didn't, we need to make sure that we have done that. It could be that they're very similar to something that we assessed last year. And if we did some good documentation last year, we can just tweak it a little bit and we've got that. Could be that it's brand new, it's something that's never happened before, and therefore we really need to work through that process and understand how we're going to recognize that revenue. The other area that I've had a lot from auditors and also from preparers is preparers would say, you know, we spent ages preparing these papers and we handed them to the auditors and they basically said that they're not giving us the information that we need. What I think there's confusion around is we often say, and as technical people, I throw it out all the time, you need to do a position paper on this. What do I mean by a position paper? And the concept that's been given to me is position paper versus a concept paper. It's much easier to sit and write a paper that regurgitates the accounting standard because we can all do that. But that doesn't actually help with anything because we've got an accounting standard. It's no need to regurgitate what's in there. When we're talking about position papers, what we're talking about is something that is very specific to you. In this scenario, for this particular agreement that we have got, how do we account for it? And why have we decided to account for it this way? And where there was a choice, why did we go along one way versus the other? So that position paper can't be picked up and sent to anyone else and they can just use it and rename it because it's very specific to you, unless obviously they've got an identical grant. But that's what we're looking for when we talk about these position papers and really justifying what you're doing. If you're anything like me, you struggle to remember what you did last week, never mind last financial year. So actually coming up with a really detailed position paper so people can understand the rationale. If you change, if your staff turnover changes, or if you leave, someone else can pick that up. I have had a number of times this year where entities have said to me, we need to start again on our AASB 15 and 1058. And I said, what do you mean you need to start again? You've done it last year. They said the person who did it last year's left. There's no documentation at all about why certain things have been done in certain ways. And we can't follow it. And we actually think that they've got some of them wrong. Now, that isn't a horrible position to be. Nobody wants to be in that position. So please make sure that you have actually got some documentation around why you've done certain things certain ways. It's really important to also remember that if you're in AASB 15 or if you're in the exception to 1058, which I'm actually going to talk about next, the standard doesn't care when you receive the cash. So even though you might have some project milestones, you might get 20% of the cash on signing of the report, on signing of the agreement, standard doesn't care because you haven't done any work. So really understanding what's a trigger point for revenue recognition versus what's a milestone within the contract that really doesn't flow through to the accounting for revenue. So let's look at my hints. I've already told you my start early one. There is no shortcut for reading agreements. I have reviewed more agreements than you can shake a stick at over the last few years, and there is no shortcut. I can't tell you, don't worry, just review these 3 clauses and you'll be all good, because there are many terms and conditions that are buried away in really obscure clauses that could potentially change your accounting. So there is no substitute for starting at the start and going to the end, which links into my next one. You guys as finance people probably aren't negotiating these contracts. You probably are not intimately reading these contracts, but there is somebody in your organization who is. If you can talk to them, educate them, to try and get them to understand, they don't need to be an expert on the standards. What they do need to think about is, what are you looking for? How could it affect your revenue recognition? And try and improve that process. You may not believe my next comment, but I've heard it lots of times, in that if that process can work, what entities have actually found is that the whole contract management system, their governance system of it, the whole understanding of what we have to do under particular grant agreements has improved, and they have said that it's become much more efficient and effective. Lots of times when I've reviewed these agreements, I've read it and said, I don't know what you have to do for the money. And the comment that's come back is, yeah, and it's a bit vague, we get that. From a governance perspective, ignore the whole accounting. From a governance perspective, if you've received some money and you can't appropriately say that you have dealt with it in accordance with the agreement, that's a huge risk. So if we can try and make this process better, not just from an accounting side, but also from a governance side, from an efficiency side as well, I think that will be really helpful for everybody. I realize that you probably sat rolling your eyes at me and going, well, we're just going to have to do it as finance people. You might, but the only people it's making it harder for is you guys. So if you could try and have the conversations, maybe might help a little bit. And I definitely am hearing that there's been more efficiencies for people who have done that. I don't want to talk today about the theory of the standards, because I've done that to death before in other sessions. What I do want to do, however, is just pick on one element of the standard, because this is an area that I am hearing lots of questions about, and I think there is still a huge amount of confusion around. This is where you are receiving funds, and we often hear this as the capital grants exception. It is, but it's not necessarily all capital grants. So you've received some funds, cash we'll call it, to acquire or construct a non-financial asset. Let's call it a building, in my example. So there is identified specifications for that building, and that's what you have to do. You don't transfer that asset, that building, to anybody else. Now, because you are not transferring that building to anybody else, it will sit on your books. You are deemed to control it. You cannot be in AASB 15, because AASB 15 involves the transfer of goods and services from you to somebody else. If you are not doing that, you cannot be within 15. Can't emphasize that enough. If you also have an obligation to repay the money if you do the wrong thing, they're the 3 criteria. So if you meet these 3 criteria, you are in 1058, but you're able to use this exception. And what it does effectively is, whilst it won't allow you to go within 15, you are getting the same accounting as if you were. So consequently, what you do is, assuming we receive the money up front, you would debit cash, you would credit a contract liability to recognize the fact that you have to work. Do you have to do something for that funding? You would then release that contract liability and recognize the income as you build the building. When the building's finished, you've got a building sat on your balance sheet. You've recognized all of the revenue because you've done what you were supposed to do for that money. Assuming everything beautifully matches, your contract liability is nil and you've spent all of the cash. So in the past, pre these standards, we would have said debit cash, credit income as soon as you receive that money. And now we're saying you can defer that until you have built the building. So that's the exception, the theory. Some of the questions that I'm getting in relation to this is, now I can't say that 5th word on that first question. So consequently, we'll have to talk about, what granular level do we need this? How specific do identified specifications need to be? We pretty much didn't give you any guidance within the standard, so it will absolutely be a judgment call. However, if we're looking at it, the example within the standard that we use is a hospital bed. And I've had comments that people have said to me, well, that's not really very specific, is it? A hospital bed. We don't specify the brand, we don't specify the model, but we also don't say, here, have some money, just go and buy some capital assets for the hospital. It is in there to say this is the narrow scope that you're allowed to buy it in. Now, I think that's different from go and construct a building, because that's quite a different element, but it will absolutely be a judgment call. What I would recommend is, if you do receive some funding and you say, I'm just not sure whether the identified specification bit is met, we need to look and say, how significant is this funding? If it's not material, no, nobody's worried about it. If, however, it is significant, do your position paper, run it through the auditors pre-year end, and get everyone agreeing on that. Maybe that there's some more guidance comes out on this, but at this point in time, we don't have any others. It's a judgment issue. The next question I often get is, does it matter who decided on the specified identifications? So for example, the not-for-profit creates a master plan for a project and the government has agreed to fund that project. Well, this is another one that it depends. Because I think if the government has given you some money to do a particular thing, let's say it was build a park. Government has said, okay, we want you to build a park. We're going to give you $5 million. Just go away, build a park. And you don't have to report back. Yes, you create a master plan, but it doesn't need approving or anything like that. You might only spend $100,000 whacking a bit of playground equipment in. You've satisfied your requirement. Or is it that you create a master plan, the government then give you the funding, but they have had to approve that master plan. Any changes to that master plan, they have to approve. So even though you developed it, effectively, it's just because the government didn't want to spend the time to do that, and they are actually approving it and can't have any changes within that. So it's looking at the facts and circumstances. Next one that I get quite regularly, we have a lot of grants which are paid in milestones, such as execution after 50% and 100%. Can we recognise revenue on these milestone payments? How much must we recognise once we have an asset? Now, I've answered this question on the previous slide, but this is the question I get most often. So I put it in here again so I could repeat it. It is not about when you have received the cash. It is not about the project milestones. So if you're getting money on execution, you have not done anything. You can only recognize the revenue as you have completed the work that you are meant to do. So that's how we recognize revenue if we are within this exception. So hopefully that helps a little bit, because this accounting treatment is something that people really do quite like. And as much as they may not like the rest of the standard, this is one they really do quite like. So I just want to make sure that you're all on board and on top of this one. All right, we're moving away from revenue. We're going to move into leases. My experience of the leasing standard is that lots of people got a huge shock when they really spent the time trying to implement this particular leasing standard. Lots of comments I got, it's much harder than we thought it was going to be. We really wish we'd allowed more time. And I think that's a fair comment because it's not finance lease accounting. I'm not going to go through the theory of how to do lease accounting. What I want to focus on today is what happens in year 2 of lease accounting as leases change. Fundamentally, I agree with the concept of this standard. I absolutely think we should have lease liabilities on balance sheet. I'm dealing with the right of use asset because I don't know where else it would go. What I do think, however, is there is a number of complexities within this standard that quite possibly don't need to be there. I don't have an alternative, but I just find that some bits of this standard are incredibly complicated. And that's why we're going through these examples today. Because I do suspect over the next 12, 18, 24 months, we will see a significant number of changes in leases, just because of the current circumstances that we're in. So we're going to work through the treatment. We're going to compare and contrast an example and hopefully give you some understanding of how we deal with these. The first thing we have to work out is if anything changes within a lease, is it a reassessment or is it a modification? A reassessment is where something existed at day 1 and either we've changed our mind, so it could be that we had an option to renew and we said we weren't going to renew the option, and then as time's ticked on, we've decided we are. Or it could be something where the condition existed, but we didn't have enough information and we've got better information. For example, a CPI increase. I'm going to look at an example around that. So the terms and conditions were there, we either changed our mind or we got better information. A modification is where there was no option to change it in the original lease, but we have changed it. So consequently, the lease has changed. So you can see here, we might have increased the scope. We might have changed the lease term. we've changed the consideration. And there was no clause initially to enable us to do that. The reason it's so important to know the difference between the two is because the accounting is quite different between the two. So let's work through some examples. The first thing we're going to look at is a reassessment, and this is where we've got CPI. I reckon at least 95% of leases that I look at have a CPI clause within them. So the first one we're going to look at, we've got a 5-year lease of property and annual lease payments of $75,000. There is a CPI increase within there. We know at commencement date that CPI is 100, effectively just base rate. At the end of year 1, I tell you it's 103, and at the end of year 2, I tell you it's 105. I could keep going. I'm stopping at the end of year 2. I tell you that the incremental borrowing rate is 5%, purely just for interest. We're not going to use that in this example particularly. So what I want you to think about is, how do we account for CPI? So in this example, based on the numbers I've given you, we've got at the start of the lease, at the end of year 1, and at the end of year 2. And how do we actually deal with the fact CPI? Again, I'm just going to pause for a couple of seconds because I want you guys to have a think about it. Feel free if you want to type it in the chat box. All right. This is a change due to an index. We do not know what CPI is going to be in the future. Yes, there are economic forecasts galore, but we do not know until the point in time that CPI is announced for the particular period that we are looking at. And we can't guess what CPI is going to be. That's not what the standard requires us to do. So whenever we've got something that's based on a rate or index, we assume that the payments that we make today are going to be the same payments that we make for the life of the lease until we know something different. So therefore, at the commencement of the lease, we don't know anything different. All we know is that we pay $75,000. So we factor that in for the remaining life of the lease. At the end of year 1, we now know that CPI is 103, and therefore we know something different. Consequently, we change those payments. So at commencement date, $75,000 for the life of the lease. I've shown annual payments because it's much easier for me to show 5 payments than try and put a table in here that shows 60 payments. So I know that realistically most of you have monthly payments, but it's just much easier for me to illustrate. Come the end of year 1, we've already paid the year 1 payment, so that's done, dusted. So we adjust the remaining payments by the 3% and factor that in for the remaining life of the lease. At the end of year 2, when CPI goes up to 105, again, we've already paid year 1 and year 2. So we factor in that increase from 103 to 105 into the remaining life of the lease. What this tells us is that this standard is not set and forget. We've got CPI every time something changes, every time CPI kicks in and our payments change, we need to recalculate. I've told you here that we still use the 5% incremental borrowing rate that I told you on the previous slide. So if all that's happened is a change in CPI, we do not change the discount rate. We keep it exactly the same. This is painful for one lease. If you've got more than one lease, you're going to be doing this potentially every month, because I can guarantee that your leases do not all have the same annual review date. So how are we tracking this? You might go, it's not material. Seriously, it's 3%, we'll just ignore it. But the problem is, because we've got this over every payment, it suddenly becomes very material very quickly. There's only one way to know whether it's material or not, and that's to calculate it. If you've already calculated it, you might as well just book it. So in the CPI example, I credit lease liability. The other side of the entry goes to right of use. Right of use is effectively my balancing figure. So again, happy to take any questions on this as we go throughout. So that's the reassessment with the CPI. We're going to get harder as we go. Now we're going to deal with a modification. So this is where we didn't have the original terms and conditions that allowed us flexibility. So we've changed something. The way that we deal with an accounting modification depends on what the change was. So you can see if we start on the left-hand side, if we're increasing the scope, we're going from 3 floors to 4 floors, for example. It depends whether we are paying the standalone selling price for that 4th floor. And if we are, it's just a separate lease, just deal with it completely differently. If we're not, we flick into the middle of the table. We end up revising discount rates. We adjust the existing lease liability. We adjust the right of use asset. If we go over onto the far right-hand side, which is the example that we're going to work through, it's where we're decreasing the scope. So for example, we're going from 4 floors down to 3. We're shortening the lease. We're reducing how much space we've got. We revise the discount rate, and what we do is we treat it like a deemed disposal. So there will be a gain or a loss on disposal. It's the only one that goes through the P&L. That's what we're going to work through. So the particular example that we've got is for a 10-year lease, and we have got 10,000 square meters of storage space that we are using. Equally applicable to anything. Could be office space, could be warehouse space, could be whatever else it is that you guys have got. For that 10,000 square meters, we pay $100,000 per annum in rent. Now, I'm telling you at day one what all the figures are. I forced the right of use and the lease liability to be the same. I'm also telling you what the interest rate is. And I tell you that everything is fixed. There is no option to vary. I can't change the term. I can't change the storage space. I can't change the rent. Everything is locked in. Everything is fixed. So we happily tick through and we continue year on year in our lease. Then we get to the start of year 7 when there is 4 years remaining of the lease. And we go, you know what? Don't need this much space. So what we should do is we should talk to the landlord. We should reduce it. We really just want 7,500 square meters. So we talk to the landlord. Landlord's happy. Because in my example, I can change the figures, I force everything to be beautifully 25% reduction. So I reduce the space to 7,500. I reduce the rent to 75,000. At the start of year 7, which is the time when this particular arrangement is taking place, I tell you what the right of use is and I tell you what the liability is. So remember with lease accounting that even if the right of use and the lease liability were the same at day 1, they will never be the same again going forward. You reduce the right of use based on a straight line depreciation, and you reduce the lease liability based on the effective interest rate. They will never ever be the same again until the end when everything is nil. Because I'm changing the lease, because I've got a modification and I'm changing the scope, I have to change the discount rate. So I told you at day 1 it was 7%. I have to go out and I have to reassess it using my methodology at the start of year 7. And I'm telling you it's gone up. It's gone from 7% to 8%. How do I deal with this? Now, again, I could give you half an hour to go away and tell you to come back with the journals. What we've got is an issue here that many people go, I don't know, I've got no idea how to deal with this. So let's work through them. Because it's a modification, we've actually got a 2-step process. The first thing that we have to do is deal with the fact we have decreased the scope of the lease and everything has dropped. Now, because in my example, I made everything 75%, I can calculate 75% of the right of use and 75% of the lease liability. I understand in real life that might not happen, but it's just so much easier for me to illustrate for training purposes. Realistically, you guys would have to calculate the new lease liability. The right of use you could probably take on a percentage. So I've calculated my new amounts. So I then need to adjust. I drop my lease liability by the difference between my old lease liability at the beginning of year 7 and my new lease liability that I've just calculated. And I do the same for the right of use. Now, because they were on different levels, 25% of this is not the same as 25% of that. So there's a difference between them. That difference is my gain on modification. It's a gain in this particular example. So that 14,444 I take to the income statement because I'm disposing of a portion of my asset. So what I've done now, I've dealt with the fact that my scope has dropped, dealt with the fact my liability has dropped, haven't dealt with the fact that the interest rate has changed. So what I now have to do is I have to remeasure my lease liability to take into account the revised discount rate. Remember, it moved from 7% to 8%. The higher the discount rate, the lower your lease liability will be because we're discounting it by more. So what we've got here is a situation where we are decreasing the lease liability by 5,631. The other side of the entry is a balancing figure to right of use asset. 2-step process. And they're the different calculations we do. I'm not going to ask how many of you would have come up with this figure if I'd left you for 30 minutes, because my guess is the vast majority of you would not have been able to. This is not an easy thing to do. And if you remember when I talked about those COVID concessions, the rent concessions, this is why the International Board introduced the concession that they did, because the alternative was you would have had to go through and recalculate everything. So what I want to do is go through and contrast. I've got exactly the same words on this slide, apart from the bit next to the black arrow. So there is an option on day one to vary the space at any time. Everything else is fixed. There's an option to vary the space. So consequently, when I get to year 7 now, I say I'd like to exercise that option, please. I'd like to reduce my space to 7.5, and consequently my rent drops again. Now, because there was that option at day 1, it means that what I've done is I've changed my mind. I've reassessed. So it's not a modification anymore. The entries is I still recalculate my lease liability using the revised discount rate. That journal is the difference between the old liability and the new liability. And the other side of my entry is just a balancing figure to right of use. One-step process, much easier calculation. So if we look at what those balances look like, what we have here is in the second column, what the numbers were before I did anything to the lease, before I fiddled with it. So that's what my numbers were at the beginning of year 7. Then I'm showing you what the numbers look like under a modification and under a reassessment. You can see that the lease liability is the same in both. And that makes sense because lease liability is something that we can calculate. It's fixed. It's a factor. You know, it's just a mathematical number. The difference lies in my right of use. The reason that they are different between the modification and the reassessment is because of the fact that under the modification, I took a gain on modification to the profit and loss. So that's the difference between the two, is that $14,000. If you have any changes in your leases, you need to work out, is it a reassessment or a modification, and go through this particular calculation process. There's no questions come through at this point. So I'm going to keep going on, but more than happy to take any questions on these as we go towards the end as well. I can't run any session for not-for-profits without answering the question that is probably going to come through on, is there an update on peppercorn significantly below market value? AASB have stated that that concession to use cost will be available until the not-for-profit framework has been finalised. The board has changed. So as Aidan mentioned at the start, I'm no longer on the board. There's 3 new board members this year, including a new chair from last time the standards was issued. So he joined last year. I don't have a feel for what the current board is going to do. It is something that I'm getting a lot of feedback in some of the discussions I'm having with people around, can we have some more certainty around this? So as we talk about the project, I want your help with later. And here's some feedback I'll be passing. What I would suggest to you, however, because at this point we don't know what's going to happen, I would suggest that if you do undertake a new peppercorn, significantly below market value, concessionary lease, whatever you want to call it, get the fair value information when you undertake that lease. Much easier to get it at the time than it is to go backwards. So I would be collecting that information for new leases. I wouldn't be stressing about any that are existing at this point till we know what's going to happen. But certainly I would be looking to collect that information for new leases. And that's not me telling you any inside information because I don't know what the board will do. It's purely to make life easier for you guys. If you never use the information that you've got, don't worry about it. But better to have it now, and the lessor should be able to give you that information if you ask at the time. All right, so I just want to move to, this is not a new standard. This is a standard that became effective for 30 June last year, and we did talk about it in last year's session. However, what I'm seeing is some really bad compliance with this standard. So that's why I wanted to use it as a reminder. So what we've got is There is no requirement for not-for-profits to have to move to general purpose. But we said if you are continuing to do special purpose, we want you to give us some more transparency around what you are doing. We want you to tell us, do you comply with recognition and measurement? Either you do except for, or you've got no idea. Just tell us one of those three. We don't want you to change anything, just tell us one of those three. The second component of the disclosure is around consolidation and equity accounting. If you know that you have subsidiaries, JVs, or associates, do you do full consolidation and equity accounting? If you don't, why not? Don't want you to do it, just tell us why you don't. Or if you do not know whether you have any subsidiaries, associates, or joint ventures because the ACNC only requires lodgement of charity accounts, that's fine, just tell us that. So it's more about that transparency. It's not about you changing anything. I want to show you some real examples that I've pulled and tell you why I have issues with these examples. So this is one of them. Financial statements have been prepared in accordance with the mandatory standards. What does that mean? If you ask me, every single accounting standard is mandatory. So therefore, think very carefully about using that terminology, because unless you define what you mean, I think that it just adds confusion to the financial statements. We then say we talk about some in the second paragraph. I'm not going to read these to you. In the second paragraph, we say that we apply the basis of accounting specified by all accounting standards. And that seems to imply that we're doing recognition and measurement, although it's not clear at this point. And then we have the disclosure requirements of these certain standards. AASB 1031 does not exist. So please make sure that you are not referring to standards that do not exist. And that if you are naming standards, that you've got the names correct. So for example, AASB 107 is called Statement of Cash Flows, not Cash Flow Statement. So then we say in the last paragraph, we've concluded that the requirements set out in 10 and 128 are not applicable. So that's to do with control, it's to do with associates and joint ventures. Because we don't have any subsidiaries, associates, or joint ventures, that's fine. Hence, we comply with all recognition and measurement. So they've included a statement that they do comply. I'm not entirely convinced based on the words that are above that, but it's absolutely got nothing to do with whether you do have subsidiaries, associates, or joint ventures. So we've got a lot of words in here. It could be satisfied, and we meet the requirements of the standard by saying we do comply with all recognition and measurement requirements, and we do not have subsidiaries, associates, or joint ventures. Those two paragraphs could have been removed. You have to comply with the mandatory standards that are specified within the ACNC Act, which I think is what that list is trying to show. It's not the right list, but I think that's what they're trying to show. So just think about how, again, we can declutter, we can not obscure the information. The next one, a little bit longer. Again, we talk about a lot that we are complying with the ACNC Act. We mention it 3 times in this basis of preparation, which we're obscuring and decluttering. Probably don't need to do that. We talk about that there's disclosures to satisfy the New South Wales Fundraising Act. Fantastic. And then we say we've prepared the financials. I'm in the 3rd paragraph now, in accordance with the accounting standards adopted by the Australian Standards Board. So again, that to me says every single standard you have complied with. Contains only the disclosures that are mandatory under the standards. Well, to me, that's every single disclosure that's relevant, and those considered necessary. And also we've complied with those particular standards. You can see again, we talk about materiality, which doesn't exist. So I read that, there's a lot of words. This is a good half page of the financial statements. You haven't actually met the requirements of the standard that I've talked about on the previous 2 slides. And I still don't know what you've actually done. So think about, what are we doing? Think about, what are we disclosing? We talk 3 times about the ACNC Act. We talk twice about the fact that we are a not-for-profit. But it doesn't actually tell me anything. So it's just some of those examples. We do have that requirement to meet, and I'll flick back. This one, make sure that we are complying with this, because this is a mandatory standard that is certainly, if you are ACNC registered, you have to comply with. All right, next component I'm going to talk about is around some ACNC best practice disclosures that they have recently put out. They have noted that they're not intended to replace the disclosures in the AASBs. However, not all charities have to comply with the Australian accounting standards, whereas they want all charities to consider putting this in. So I'm going to talk about each of the elements in its own right. The first one is information about the sources of government revenue. So where a charity receives more than 10% of its revenue from government sources. So this is a bright line. We don't see these very often. This is a bright line. More than 10% of revenue from government sources. That doesn't say government grants. So that could mean if you're an NDIS provider, includes that. If you deal with the government in any other way, it includes that. It includes grants. It includes JobKeeper. It includes your cash flow boost. They want separate disclosure of the revenue from government, including the total amount from each level of government. Then they want you to name names of the top 10 sources of government revenue, broken down into the individual levels. And if you do have more than 10, either put it in an appendix or link it to the AIS. Here's an example of what they have shown within the best practice guide on what this might look like. So you can see here, we've got 10 different entities that are listed, broken up into the Commonwealth government, the state government, and the local government, and splitting this out. I don't particularly have an issue with this disclosure. I think it could be useful information. I do wonder if the local councils might have some issues with some of the disclosures stating how much they've given to each of the entities. But this is what the best practice, not mandatory, it's a best practice recommendation. The second one is about economic dependency. So if you are dependent on the government for significant revenue or financial support, for example, the program and services that you offer would be significantly reduced without the particular source of government funds, or a significant government contract is expiring within the next reporting period. They want you to include an economic dependency note. I don't have an issue with that in theory. Tell me that you are reliant, tell me that you are dependent. Then what they want you to do is give management's assessment of the likelihood the economic support will continue. Now this I think could be potentially a little bit risky. This is their example note that they've included. So what they've got in the second from last, or the very last sentence says negotiations for a new contract have commenced and the responsible people have no reason to believe that we will discontinue our support. The government will discontinue their support. I just think it's possibly a big call to be made by management around what is the likelihood that that support will continue. It's unclear how this links into your going concern assessments that you're already doing. So again, they are best practice, they're not mandatory. And just think very carefully about the words that you are going to include, because you don't want to sound too overconfident if you really don't have evidence around that. We should be having some support. If this is in your financial statements, it will need to be audited. The last element is around disclosed funding that has been received from government but is not yet recognised as revenue. Now the ACNC have acknowledged that if an entity is complying with AASB 15 and 1058, it is going to disclose this information anyway, but not all of the charities are. Where I have potentially an issue with this one is I think that there will be very different answers depending on whether I am or I am not complying with AASB 15 and 1058. Because if I'm not complying, I really want to match. And therefore what I will do is I will defer all my revenue until I've spent the money. So I will have a huge amount that I disclose here. If, however, I am complying with AASB 1058, I have to recognise the revenue when I receive it. And therefore I'll have a very low amount here. Anything here will only be income that is received under AASB 15 or income received under that exception to 1058. So I just think if we're going to disclose this, we should make it very clear on how we've decided whether something is going to be deferred or not. The last comment that they've made, and they chucked within this section, even though it's nothing to do with this section, is at the bottom bullet point there. They said in the cash flow statement, consider having a separate line item for funding from government. So as I said, these are not mandatory. They're ACNC best practice. What they often do is that if nobody takes up their best practice recommendations, They can sometimes then mandate it the following year, but generally would mandate it in the AIS, which I think is a better place for this to be than in the financials. So the reporting framework is our next section that we're going to talk about. I'm only going to talk about the parts that are relevant for you guys as not-for-profits, but what I've done is just put up this chart so you can see where you sit in the who is going to be impacted. So we are over in the far right column. My green cross means you are not affected. So as you can see, the only private sector not-for-profits who are impacted by the changes to the framework are those of you who are currently producing RDR or reduced disclosure financial statements. And that's because RDR will not exist anymore from 1st of July 2021. So that's what we're going to focus on. That's what we're going to talk about for today's session. So there is a new Tier 2 disclosure standard. We're not getting rid of Tier 2 at all completely. It's just changed. It's no longer RDR. It's going to be simplified disclosures. And whereas in the past, you used to go through every single accounting standard and looked at what all of the shading was, and you ignored the shading bit. Now what we do is we jump into a separate standard, and that standard lists out all of the presentation and disclosure requirements for entities who are adopting this new Tier 2. We also used a different approach for adopting or for developing this Tier 2. And that's partly because when we went out and got some feedback on why the take-up was so low, particularly in the for-profit space, they said that they didn't think the difference between full Tier 1 and our RDR was enough to make them drop, and also was not enough to make them jump up from special purpose. So consequently, the way that we developed 1060 was to use IFRS for SMEs. So that is an international standard. The SME in this context is not the mum and dad type organizations. It's the level below the listeds. So the International Board has developed this standalone standard. It does include recognition and measurement. We haven't used the recognition and measurement components. We've only used the disclosure and presentation parts. And what we've said is if the recognition and measurement in IFRS for SMEs is the same as full IFRS, we're just going to use the IFRS for SME disclosure. If it's different, so for example, the revenue is different, we've pulled in disclosures from other standards and made sure that we believe it's of a sufficient level. We haven't pulled in all of the disclosures, but it's still reduced. And then we looked and we said, is there any other disclosures that should be included? So is there any specific Australian issue that means that we need some extra disclosures compared to IFRS for SME? And we pulled in two in that aspect. One was audit fees, one was imputation credits, so effectively your franking credits. Probably not relevant to you for the franking credit side, but certainly the audit fees are. So consequently, we worked up rather than down, which means that there are less disclosures in this standard. So we still have our two tiers. Tier 1 will always remain because that's our full IFRS. Not necessarily better, particularly for you guys, because there's a lot of information in there. Tier 2 will now become the simplified disclosure requirements. Still, the numbers are the same, so it's all recognition and measurement requirements from the other standards. It's still consolidation, still equity accounting. Most of the presentation rules, and I'm just going to talk through some changes, but all of the disclosures sit in that standalone standard, AASB 1060. So what do we do if we are currently preparing RDR financials? RDR will not exist from the 1st of July 21. So you can still use it for 30 June 21. You cannot use it after that. So our financial statements will need to refer to either the Australian accounting standards, which is your full IFRS, which I'm not recommending, or Australian accounting standards simplified disclosures. Two ways you can do it. You can either look at your financials for the current year and go, let's get out everything that doesn't need to be in there anymore. Let's add back the couple of extra things that need to go in. That will take time on day one, but going forward, life will be much easier. There will be less to prepare on an ongoing basis. Or you can say, no, that's all too hard. So let's just keep the financials as they are, and we'll just bring in the extra disclosures. That works as well because SDS is only minimum disclosures. So you can always disclose more, you just can't disclose less. However, whilst it's quicker on day one, it will actually mean that going forward, you are preparing more disclosures than you quite possibly need. And if we think about materiality, if we think about obscuring information, probably a good idea to get some of that out. So that's what you need to do. The other challenge with that second approach is because ADR is not going to exist going forward, if a new standard is released, you will then have to either adopt the full IFRS or adopt the SDS changes. So you're going to end up with kind of some weird hybrid around that. So let's have a look at a couple of the presentation changes within 1060. If you picture your statement of changes in equity at the moment, so one of the 4 primary statements, for many of you, that will probably have retained profits going brought forward, profit for the year, retained profits going forward. It's kind of a bit of a nothing statement. So what 1060 allows you to do is it says, if the only changes to equity during the year are one of these 4 items, you can choose to get rid of your statement of changes in equity. What you do is you present a statement of income and retained earnings, which looks like this. Those of us who remember pre-IFRS in Australia will realise this looks very familiar because it's effectively what we used to do in Australia. So it's your normal income statement with a retained earnings reconciliation at the bottom of it. Completely optional, choose to do it if you want, choose to do your statement of changes in equity if you want to. But just we might see a little bit differences in our financial statements, and that's where this has been driven from. So overall, my comments on 1060, generally there are less disclosures in 1060 compared to RDR. So I would really encourage you to do that bigger step and really go through and cull. Obviously, it depends on the balances and transactions of the entities. I can't tell you that you're all going to get a 10% drop in disclosures or whatever it is, because it really depends on what you've got. 1060 continues to be a minimum level of disclosures. And I've just pulled this in because it's really important to still remember that even if 1060 doesn't require you to disclose something, if you've had a major transaction and you do not believe the disclosures are sufficient, you always add on that extra information to make sure we are telling the story appropriately. The not-for-profit framework. So whilst I said you weren't impacted at the moment, what we have got is a framework that is probably the biggest priority of the AASB at this point in time. There was a standard that was released, I'm going to say the year before last, I don't think it was last year, that talked about changing the definition of a not-for-profit. That is still on the agenda, the work plan of the AASB, but the priority has been lowered. There were some very differing views on that definition. So it does still exist, but with a lower priority. The biggest priority now is the reporting framework. And a disclosure paper is expected, a discussion paper rather, in 2021. The board decided not to go directly to an exposure draft. The reason for that is because if you issued an exposure draft will give you an answer. And if everybody disagreed with that answer, they'd have to come back, reissue an exposure draft, do a lot more work, and take some time. If they release a discussion paper, however, they can include a preferred option with some other options there. So if everybody comes back and goes, we hate your preferred option, but we really like option number 3, you can then issue an exposure draft, which you're fairly certain will get through, and the process should be quicker. So keep your eye out for this discussion paper when it comes. I imagine there will be roundtables. I imagine that there will be a significant number of webinars. So really encourage everybody to get involved in this. What we're likely to see is 3 tiers of financial statements, being the bottom one, probably going to be cash accounting. Top one, probably going to be tier 2. And in the middle, some sort of modified accrual. Now you can always go above, you just can't go below those thresholds. So, but until the discussion paper comes out, we won't know for definite. Just wanted to raise your attention or raise your awareness to a consultation paper. The comment period has ended. It ended on the 21st of March, but Treasury have put out a proposal to raise the thresholds. One of the questions that they asked was in the consultation paper, are we better off waiting to make sure we've got harmonisation between states and territories, or are we better off just doing something for the ACNC registered entities? So it'll be interesting to see people's views on that. So their proposed thresholds are to move the small from 250 to 500 and the large from 1 million to 3 million. So let's see, it's a bit of a watch this space, and we'll see what comes through from the Treasury results. So we'll be analysing the comments now. So just to finish off, and I've got a request for help for you. So we've commented that I am no longer on the AASB. However, I have been seconded back to the staff to help them with some projects. The main project that I'm working on is what are your issues around the not-for-profit revenue standards? So we've talked about some of them through the course of this session. Without making any promises to you, if I could wave a magic wand and change something within a standard, give you some FAQ, give you some more educational material or something else, what would that be? What would that look like? So some of the thoughts that, I've already talked about, things like the peppercorn, and try and get some certainty around that. So it's the opportunity for you to give some feedback to the AASB in an informal way. Would be no more than 10 minutes of your time. So if you are happy for me to contact you and to us to have this quick informal discussion, I would really, really appreciate it. We find preparers of not-for-profit financial statements the hardest group to actually engage with, and you're the ones who are the most impacted on this. There will be a full post-implementation review on this standard in 2022. This is more that, is there anything really quickly that the board can do to help you guys going forward? So we are going to put a poll up, which is where if you are happy to have me contact you, if you can type a yes in here and we'll get your contact details and I will come back to you and just organise some time. I promise it will be no more than 10-15 minutes, but I would really appreciate it. So I'm now going to hand back over to Aidan.
So I'd like to thank Carmen for her insights. I told you at the beginning that this would be one of the top 3 presentations you've ever attended, so I told you so. You've always got the chance now to speak with Carmen also. I also want to especially thank Carmen because the bug that she's suffering for as well, she still presented to us and delivered an expert presentation to us. I'm pretty sure you can't catch any illnesses via Zoom, although they are adding new features all the time. I don't think that's one of the features they've added yet. So thank you, Carmen, for doing that. All right, so the poll's now gone. Thank you all for responding to that. We've just got one other poll that we'd just like to put up. So Carmen's talked in particular about the 15, 105, 8 and 16. This is if you want any assistance with those. So we're coming up to the June year ends. It's only 3 months away. And as Carmen said, it's better to deal with these things earlier. So if you want us to reach out to you and contact you or discuss any of these standards, which is both in relation to the changes or the AASB 16, if there's any modifications, reassessments required, or anything you're not sure about 15.1058, please reach out to us. So just tick the poll question there. If you have any other questions, tick that, and then we will reach out to you as well. So thank you once again for joining us today. Thank you again to Carmen. Please stay safe, and we'll see you all next time in the near future. Thank you.